So you end up in this period here of August a lot of times where things are just really closely correlated during COMEX hours in particular with the things like the dollar index. And so that can be good, that can be bad. And so far in the month of August, it's been bad. The dollar's been rallying and silver's down something like 9% month to date, and gold's down around 3%. It's just been horrible. Probably won't continue this way. There's not a lot of reason for the dollar to continue higher. It's about to run into some pretty stiff resistance, just around 103.
Gold prices hovered near a one-month low on Friday and were heading for their third consecutive weekly dip, as the dollar and bond yields strengthened after data showed U.S. producer prices increased in July. The dollar gained 0.3% against its rivals and was on track for its fourth consecutive weekly gain, making gold more expensive for other currency holders. In a recent interview, Craig Hemke, founder of the TF Metals Report, highlighted that there had been a negative impact in August as the dollar has been strengthening, leading to a decline in silver and gold prices by around 9% and 3% respectively. Hemke believes this trend may not continue, as there are reasons for the dollar's ascent to slow down due to resistance levels. Global central bank demand for precious metals has shown fluctuations, including a recent positive shift after a period of net selling. Hemke considers the possibility that the seasonal nature of trading could contribute to these patterns, as people may be less engaged during the summer months, but refocus on the market in late August and September. The U.S. Federal Reserve's aggressive monetary tightening measures have exerted significant devaluation pressure on non-dollar currencies by steadily raising interest rates since early 2022. Under this circumstance, only increasing gold reserves can help other countries stabilize the exchange rates of their currencies. Hemke emphasizes the importance of owning physical precious metals like gold and silver to protect against the devaluation of the dollar and potential economic challenges ahead. He suggests that the focus should not solely be on short-term fluctuations in the markets, but rather on long-term strategies to weather likely storms that may arise in the coming years. We will now bring you clips from Craig Hemke's interview with Liberty and Finance. But before we do, if you want more videos like this, ensure you smash the subscribe button and turn on the notifications bell for more videos. Thank you, and enjoy the video.
Global central bank demand was soft. In fact, net selling March through May, but now that's back to being a positive again, something like 50 tons in June. There's a seasonality to it. I don't know, Elijah, if it can be just as easily explained as people just kind of tuning out in the summertime. I know I like to. You probably like to. Everybody else listening to us probably likes to. You're like, you know what? I'm so tired of this. I'm just not going to pay attention. I'm going to go to the lake. I'm going to go to the pool and all that kind of stuff. Then by the time you get back to August into September, people start, kind of focusing again. That probably has a little something to do with the seasonality of as well. Gold prices, typically, their lowest prices on average for the remainder, the second half of the year, come in July. Now, we've already seen maybe the lowest price of the year were back in March when we got down to 1840. But I think you can make a case from a lot of different rationale that we're going to trend higher, regardless of how frustrating this is at present in this kind of low volume dog days of summer. This next fiscal year, even this fiscal year, which ends at the end of September, U.S. government's going to be getting awful close to $1 trillion in debt service payments. Going to blast through that next year. It's hard to see where they won't. There's $24 trillion worth of existing debt that has to mature, be refunded, and rolled over in the next 3 years. Well, a lot of that stuff was issued back in the zero interest rate policy years of the previous decade. So that's going to come due. The stuff's $24 trillion that's currently only paying 1.5%. What's it going to pay if the Fed isn't rapidly cutting and reinitiating QE? 2, 3, 4. So we're going to blast through $1 trillion in annual debt service costs. And eventually you get to this point where tax revenues are, 3 trillion. The debt service is 1.5 or 2 trillion. And on top of that, you've got all the entitlement programs and the military budget and just everything else that goes with it. And the whole thing just spins out of control. The U.S. eventually goes toward like a yield curve control policy where the Fed is just simply monetizing everything above a certain percentage, like Japan, just trying to keep it under control. But the end of the great Keynesian experiment, this debt-based monetary system, is simply a mathematical certainty. We've been talking about it since 2009. We don't know when that final breaking point comes. It's like a Jenga tower. You just keep pulling out the things and putting it on top, and it's conceivable you can keep going, but eventually the whole thing falls over. And that's where we're headed. Again, it's not a function of China and Russia. They are responding, the BRIC countries are responding to that frailty, to that math, to that certainty of how this all implodes by trying to come up with some alternatives. They don't have to, their fortunes aren't tied to the dollar anymore. But it is, like I said, this is something that we are preparing for. Physical precious metal ownership, gold and silver, getting yourself out of the dollars instead of saving in dollars, which are rapidly becoming less and less, more and more worthless. Let's put it that way, less and less valuable. And own it and saving your savings, your well-being in precious metals instead is your protection against it. And that's what we've discussed at my site for going on 14 years. And so we'll continue to, not focus on, oh, look at the dollar index is up today and gold's down another $10. Whatever, fine. We're more worried about where we're going to be a couple of years from now, 5 years from now, 10 years from now, how we're going to get through this storm, because the storm is inevitably coming.
There has been increasing talk of the Brics nations, Brazil, Russia, India, China, and South Africa, developing a new currency that will rival the US dollar as the global reserve standard. Growing pressure for a new global currency comes after continued weaponization of the US dollar in the form of sanctions and trade wars. Hemke is skeptical about placing too much hope in specific events, like the BRICS meetings, to bring about rapid change. Regarding the current debt-based monetary system, Hemke explains that continuous money supply growth is necessary to service debt with progressively devalued currency. Efforts to delay the system's limitations, such as employing zero interest rates and shifting debt along the yield curve, have been strained due to rising interest costs. Hemke suggests monitoring price fluctuations and capitalizing on potential dips in precious metal prices can lead to cost savings when acquiring physical metals. However, he emphasizes the significance of gradually accumulating precious metals as a safeguard against the inevitable challenges posed by the current monetary system. Let's get back to the interview.
The eventuality of some type of alternative to the dollar, right? Because, history, that's how it works, right? Before the dollar was British pound, and then, before the British pound, the reserve currency was whatever it was, Spanish currency or the Dutch currency or whatever. It's a transient deal. The U.S. wasn't the reserve currency before 1944. It won't be the reserve currency in 2144. At some point, some alternative is going to appear. What I'm not going to stake my hopes on is some BRICS meeting in August. You and I have both been down this road before, right? I remember all the people, and you still see it. COMEX is going to collapse. COMEX won't make the September deliveries, that sort of thing. You just kind of roll your eyes, or you hear all these other stories, about the impending, great reset that's going to happen on some certain date, all that kind of stuff. I don't know. I couldn't possibly know what has been discussed behind the scenes between Russia and China, and their allies. They may discuss something, they may mention something, they may announce something. We'll see. But I've learned that the last thing I'm going to do is sit there and go, okay, I'm going to hold my gold until August the 24th. And then if I don't hear this on a certain date, I'm selling it all. I sure hope there aren't a lot of people looking at it that way. In a debt-based system, you've got to constantly be growing the money supply so that you can pay off yesterday's debt with the less valuable dollars of tomorrow. That's the only way that the thing sustains itself. Well, the problem is, as you mentioned, Elijah, it gets exponential. They tried to postpone this as long as they possibly could by running zero interest rates and taking this vast majority of this, what was 10 trillion, 15 trillion, 20 trillion, 30 some odd trillion dollars of debt and shoving it into the short end of the yield curve so that it could all be financed at 1% and 2%. The problem is now, again, the Fed has had to hike rates, trying to get inflation under control and slow the economy and all this stuff. But in doing so, that interest cost now is just soaring, and it's going to continue to soar. And the whole thing just spins faster and faster and faster and faster. Again, this is not crazy talk. This is not conspiracy theory. This is just math. And that's why people need to, Again, we talk about price, and we focus on price, and I talk about price every day at my website, but in the context of, we think maybe, if we give it a little more time here and silver comes back a little further and gold comes back a little further, and you're sitting on some powder and you want to move some money out of your savings account and call up Miles Franklin and buy yourself some physical metal, well, maybe we can save you 20 or 30 bucks. If by tracking price and using our accumulated expertise and wisdom and experience to say, well, we might get a chance to buy it $20 or $30 cheaper in about a week, then maybe we can save you some dollars. But in the end of the day, we're just kind of averaging, buying a little more here, buying a little more there, and preparing for the inevitability of all of this.
The dollar's strength and shifts may influence the direction of gold prices and central bank demand. Gold finds stability in the continual price appreciation over time compared to the devaluation threat that fiat currencies experience. How do you see the future of gold's value in light of changes in the dollar, central bank decisions, and possible economic shifts? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.